to EduTap and welcome to Finance 360 Degree session. So in today's session, we are going to discuss a very important directions that the Reserve Bank of India has released in its notification, in its press release, and this is also quite in news, okay? So the Reserve Bank of India has released the project finance directions that we are going to discuss in today's session. Now this is very important from your descriptive point of view as well as from the objective point of view in the examination, okay, for the RBI examination. And the questions can come in the phase 1 as well as phase 2 of the examination. So these guidelines, these directions become very, very important from the RBI perspective, and there are various data points that the RBI has notified in these directions. So that we are going to discuss in today's session, okay? First of all, give me a thumbs up if I am clearly audible and visible to all of you, and this session is going to be very important from your understanding point of view as well as from your factual point of view, okay? So let's get started. But before that, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. So let's get started with today's session. And good morning to all of you. Welcome to the session. So now let's get started. So the Reserve Bank of India has released the Project Finance Directions 2025. So these are the new directions that the RBI has released in the 2025. So these directions are important. Now, why was there a requirement for these directions? So remember that there is a prudential framework for resolution of stressed asset issued on June 2019. So in June 2019, there was the prudential framework that was released for the resolution of stressed assets. So what are the stressed assets? Let's say that the bank has given a loan to the micro, small and medium enterprise. So there is a small enterprise to which the bank has given the loan. Now this small enterprise is paying the EMIs, is paying the interest payments plus the principal payments, okay? So the EMIs is being paid by this small enterprise. Now let's say that one of the EMI has been missed by the small enterprise and it has been delayed by 30 days. So now the bank will realize that, okay, there is some stress that is coming in this account. The small enterprise has not paid the EMI, okay, and it has passed the mark of 30 days or 20 days or 40 days, let's say. So now the bank will approach the small enterprise that what is happening? Why are you not paying the EMI, or why have you not paid the previous EMI, okay? So now the small enterprise will show the documents to the bank that I have the required projects to get the earning in the future, but currently I am not able to get the funding, okay? That means the small enterprise has the projects so that it can get the payments in the future, it can continuously get the payment in the future, but currently it does not have enough money to pay the EMI. So the bank will realize that, okay, the small enterprise is in stress right now, but the small enterprise will be able to pay the loan back in the future. So that means the banks, this prudential framework, it provides a comprehensive framework for early recognition and resolution of stress in the borrower account. Now the bank can do the restructuring of the exposure. The bank will do the restructuring of loan where the bank can provide the moratorium period to the small enterprise. Moratorium period, like during the COVID, many of the people got the moratorium period, that is the temporary pause in the payments, okay? Or the bank can reschedule the repayment, or the bank can change the repayment structure, or the bank can decrease the interest charged on this small enterprise for the time being, okay? So the bank has the opportunity to take various steps for the resolution of stress in the borrower account so that this stressed asset do not convert into the non-performing asset, okay? So this is the restructuring of loans or restructuring of exposure that the banks can do by changing the repayment schedule, or by reducing the interest rate, by providing the moratorium period, or by providing extra funding. So this is the idea of the prudential framework that was issued in June 2019 to provide a comprehensive framework for the early recognition and resolution of stress in the borrower account, so that the banks can help in the resolution of borrower's account so that the stressed assets do not convert into the non-performing asset. Now what happened, that why there is a requirement of the project finance directions? So try to understand this point. You will understand that why we require the project finance directions, okay? So in the case of different projects, in the case of infrastructure projects, in the case of the commercial real estate projects, and in the case of residential real estate projects, many of these projects, they work on the they get the borrowing. Let's say the borrower is the entity that is working on the commercial real estate project. So the buildings are being built, or many of the shops are being built, or let's say the entity is making a residential real estate project. Okay, so the borrower is getting the loan from the lender. Okay, from the lender. Now the borrower has said that they will pay, like this residential real estate project will take 5 years in construction. So 5 years period will be taken in construction, and from 1st January 2030 they will start operating, they will start selling more and more units, or they will start taking in the tenants. Okay, so from 1st January 2030 this project will actually start operating, will actually get the tenants and such, through which the borrower will get regular payments. So now the lender is saying that okay, for the 5-year time period from 2025 till 2030 the borrower can only pay the interest rate, and from 1st January 2030 when the project will start operating, from this time period onwards the bank will take more money from the borrowers, that is the EMIs will consist of the interest payments plus the part of the principal payment. Okay, so this is the idea. So lender is giving the loan, the bank is giving the loan to the borrower, that is the entity that is working on the real estate residential project, where the project will start operating from 1st January 2030, but the loan has been taken in 2025. So till the period of 2030, so in 5 years the construction will happen and the borrower will only pay interest rate. Let's say from 1st January 2030 the borrower will start paying, when the project starts operating then the borrower will pay the interest rate plus the part of the principal. So this is the idea, that in the infrastructure projects, in the commercial real estate projects and in the residential real estate projects, there is the date of commencement of commercial operation. So once the commencement of operation happens, then the borrower starts paying a major chunk of the money back. Okay, so from the commercial operation, when the commercial operation start. Now let's say that if this date is pushed, like the entity is not able to start operations, commercial operation from 2030, it is starting the commercial operation from 2031. So the entity is asking for more time. Can we say that this is a stress? This is stress that is coming in this residential real estate project. Okay, so what happens that sometimes the date of commencement of commercial operation is pushed forward because of some, let's say, weather event has happened and the rainy season is extending long and it is taking time for the construction project to continue. The raw materials didn't come on time, so the period was extended for construction. So in these kind of infrastructure projects, the construction do take time and sometimes the date of commercial operation is pushed forward. So what happens that the date of commercial operation, so there can be delay in date of the commencement of commercial operation. They do not always reflect. So if the delay is happening in the date of commercial operation, they do not always reflect the financial stress or the borrower default. Okay, in sectors like infrastructure, delays are common, or in the construction the delays are common and often beyond the borrower's control. The RBI want to treat such genuine delays more leniently and not classify them as non-performing assets under the strict norms of the prudential framework. So that's why these kind of projects that were dependent on the date of commencement of commercial operation, these kind of projects were not under the prudential framework. So restructuring, however, restructuring of exposures or resolution of stress relating to projects on account of change in date of commencement of commercial operation was excluded from the ambit of the prudential framework. So these kind of projects, the infrastructure projects and the date of commercial operation or the date of commencement of commercial operation, these kind of projects that were linked with that date was not under the ambit of the prudential framework, and there was review that the RBI was undertaking. Now, based on the comprehensive review that the RBI has undertaken, the RBI has now issued the directions to provide a harmonized framework for project finance for these kind of loans, for these kind of lending that is connected to the date of commencement of commercial operation in infrastructure and non-infrastructure projects. And different regulated entities, banks, NBFCs and such, they provide the lending in such projects. So now we will discuss the definition of project finance, but do you understand that why there was the requirement of the Reserve Bank of India Project Finance Directions 2025? Because these kind of projects, they were not under the ambit of the prudential framework for resolution of stressed asset, and it was not easy to understand that in which project the stress is actually coming or which project is working smoothly just because of some problem, there is a delay has happened, but the entity is still able to work smoothly. So it was very hard to understand in these kind of projects, and that's why there are the new directions that the RBI has released. Okay. Now moving forward, what is project finance actually? What is the meaning of project finance? Okay. So these directions that the RBI has released, it is for project finance. So first we need to understand about the meaning of project finance. So project finance refers to the method of funding a project. So here the lenders, they are funding the project in which the revenue to be generated by the project will by the funded project serve as the primary security for the loan, also as the source of repayment. That means project finance, it refers to the method of funding a project. So lender is funding the project, the lender is providing the money to the borrower. In this case, revenue to be generated by this project, the revenue that will be generated by the project this revenue that will be generated by the project after the commercial operations start. So this revenue work as the primary security for the repayment as well as the source of repayment through which the lender will get back the big chunk of its money. Okay, this is the idea. So project finance may take the form of financing the construction of a new capital installation or enhancement of the existing installation. So this project finance means that the finance is happening, the money is provided for the construction of new project or for the enhancement of the earlier project. Okay, so building the national highways or for the tunnels also, the loans are provided by the lenders, right? So for these kind of projects, the financing of the construction, the project finance happens. So this is the idea. Now there are some conditions that the predominant source of repayment. So project finance is that kind of finance where the predominant source of repayment to the lender. So if repayment happens from the borrower to the lender, so predominant source of repayment is at least 51% must be from the cash flows arising from the project which is being financed. So that means in the case of this residential real estate, in the case of this kind of lending that the borrower has taken, the loan that the borrower has taken for the residential real estate, it will be considered project finance when most of the repayment that the borrower is doing is through the revenue that is generated through this project. Okay, so project finance, the major condition under the project finance is that the predominant source of repayment by the borrower at the time of financial closure or at the time of the loan that the borrower is taking. So the predominant source of repayment, at least 51% must be from the cash flows arising from the project itself. Okay, so after the date of commencement of commercial operation, whatever the earnings is coming to the entity, that earnings will be used, that cash flows will be used to do the repayment. This is the idea. All the lenders have a common agreement. Now try to understand that for the infrastructure projects, for the commercial real estate projects, for the residential real estate projects, there are crores of rupees that has to be given in the form of loans. 1000 crores, 100 crores, 500 crores. We will discuss about that numbers also. So huge amount of loan is given, and one single bank or one single entity cannot put so much of the money in a single entity in a single project. That's why multiple lenders come together to provide the loans for the infrastructure projects or for such kind of real estate projects. Okay, so all the lenders have a common agreement with the debtor in which the terms, and there can be different loan terms, but in the common agreement there may be different loan terms, but the date of commencement of commercial operation should be one, because if you are investing in one project, the date of commencement of commercial operation should be one. If the entity has promised that we will start from 31st January 2035, this is the date of commencement of commercial operation. So this date should be same for all the lenders who are investing in that particular project. Terms and conditions can vary, but this will not change. Now next is, so based on the comprehensive review that the RBI has done, so RBI has released the project finance directions in infrastructure and non-infrastructure like sectors in the by the regulated entities, the loan that they give to these sectors. These directions also lay down the revised regulatory treatment upon change. So if there is change that is happening in the date of commencement of commercial operations, so what will happen? The loan will be considered a stressed asset or not? So all these things have been notified in these directions. Any confusion, anyone? So now Basically, these directions shall come into force with effect from October 1, 2025. Now, these directions are applicable on all the commercial banks, including the small finance banks, excluding the payment banks, local area banks, and regional rural banks. Okay, all non-banking. So these directions will be applicable on all the NBFCs, including the housing finance companies, on all the primary urban cooperative banks and all India financial institutions. So always remember the applicability, because direct question comes from the applicability. Now coming to the definitions. So before moving forward, we do have to understand about the definitions. So date of financial closure, we have, like, there was a term that came here about the financial closure. So what is this financial closure? That we have to understand. So see, financial closure, this is the date on which the entity that is doing the project or that is undertaking the project has accumulated the funds, or that has got the approval to get the funds from the different entities. Okay, so the date of financial closure, it refers to the date on which the capital structure of the project, including the equity, how much money will be raised through equity, how much money will be raised through the debt, how much money will come from the grant. Let's say the state government with some private entity is working for an infrastructure project. So this is a PPP model where the public, that is the government, and the private entity, they are working together. So this is a PPP model where the state government is working with the private entity to build some infrastructure. So here, let's say for this kind of infrastructure project, the state government is getting the grant from the central government. Okay, so state governments do get some grants from the central government. So you can understand that the date of financial closure, so the date of financial closure, this refers to the date on which the capital structure of the project is decided, that how much money will be raised through the equity, how much money will be raised through the debt, how much money we are getting through the grants, if any, if the project is getting, accounting for minimum 90% of the total project cost, becomes legally binding on all stakeholders. That means the documents have been signed, that okay, the loan has been approved by SBI, the loan has been approved by PNB, collectively they are approving the loans, and the Union Bank of India, the Bank of Baroda, the Bank of India, so multiple lenders, some NBFCs also, so they have signed the agreements that they are going to lend for this project. So date of financial closure is not the date on which the entity gets the money. This is the date on which the documents are signed and the loans are approved, the equity is approved. I hope this is clear. Okay, so it refers to the date on which the capital structure of the project is decided and it is binding on all the stakeholders. The State Bank of India, if it has approved the loan, that means that is binding. PNB has approved the loan, let's say Bank of Baroda, Bank of India has approved the loan, so it has become binding. It's not like that they are releasing the money currently, they are only approving the loan and this has become binding. Now original date of commencement, this is the date of commencement that the entity has promised, that okay, we are going to start the project from 1st January 2035. So this is the original date of commencement that was promised by the entity to the lenders or to the stakeholders. Okay, so this is the date that was promised during the time of financial closure, when the documents were being signed, when the loans were being approved. So this is the idea. Okay, so it refers to the date as said at the time of financial closure by which the project is expected to be put to commercial use. Okay, so this is the original date of commencement of commercial operation. Now extended date, so maybe because of the delay in the construction, the date has to be extended, and the extended date is, let's say, 1st January 2036. So the extension has happened by 1 year. Now the actual date of commencement might be 31st June 2036. So this is the actual date of commencement. Okay, so there is original date that was promised, extended date, that is the extension has been taken for the operation, and actual on the actual date on which the operation is starting. Okay, so I hope this is clear. Moving forward with the general guidelines. Now the guidelines are going to come, so we will discuss the different guidelines that the bank or the lenders have to follow. Okay, so general guidelines or the phases of projects. So for the purpose of application of prudent guidelines contained in these direction, project shall be divided into 3 parts. The design phase is when the entity, that is the borrower, is doing the designing, planning, obtaining all the applicable clearances, approvals, buying the land or taking the right to use the land. Okay, till its financial closure, till the debt is approved, till the documents are signed and such. Okay, till the financial closure. Construction phase, this is the second phase which begins after the financial closure has been done, after the documents, like after the approval has been taken for different debt, after the approval has been taken for the loans that the entity will get and such, okay, and ends on the day before the actual date of commencement on commercial operation. So construction phase is actual construction that starts, okay. Operational phase, this is the last phase which starts with commencement of commercial operation by the project. So operational phase, this is the actual like commencement that has happened of the operations. So this is the last phase in which that starts with commencement of commercial operation by the project on the day of actual commencement and ends with full repayment of the project finance exposure. So this is the idea. Now for all projects that is financed by a lender, it shall be ensured that financial closure has been achieved. So if the project is being financed by a lender, the project shall start once the financial closure has been achieved and original date of commercial operation is clearly spelled out and documented prior to the disbursement of funds. So the financial closure has to finish. Financial closure means that it should be understood that from where the entity is going to raise the funds, from where the entity is going to get the funds for the project. Because let's say the SBI is only giving 10 crore rupees. So the entity for its project requires 100 crores. So SBI needs to know that from where the 90 crores will be raised. Otherwise, this project is doomed for failure. If the entity is not going to raise the fund and is not able to raise the fund from the other entities, then this project is going to go down, right? Because it was only able to raise 10 crores when it requires 100 crores. So that's why before the entities, they actually agree to pay or they actually disburse the money, before that the entities or the lenders, they always see the documents from the entity that from where the money is going to be raised and how much money will be taken from where, like from the equity, from the debt, how much money will be raised. So financial closure, the complete capital structure has to be achieved and original date of commencement of commercial operation is clearly spelled out and documented prior to disbursement of funds by any of the lender, okay. The project specific disbursement schedule, so it's not like that SBI has promised 10 crores, so it will give the 10 crores in one go. No, if the State Bank of India has promised the 10 crore, it will give it in the stage wise manner, that okay, today you are starting the construction, you require 2 crores, so 2 crores will be released, and after 3 months you require 5 crores, then 5 crores will be released. So as per the state, as per the different stages of operation, the different amount will be released, okay. So project specific disbursement schedule, again stage of completion of the project is included in the loan agreement, that at which point of time how much money will be released. The post date of commencement of commercial operation repayment schedule has been realistically designed. So after the commencement has started of the project, after the project has started to operate commercially, then there should be realistically like how much money will be repaid in what timeline. So this has to be realistically designed, okay. So basically after the DCCO repayments, after the commercial operation has started, so repayment schedule should be realistically designed. Now provided that the original or revised repayment tenure, including the moratorium period if any is given, including the period in which there is a temporary pause in the repayments, so shall not exceed 85% of the economic life of a project. So economic life of a project, this means the number of years the project is expected to generate revenue. So let's say the project is expected to generate revenue for 100 days, okay. Now 85% of that means 85 days. So the repayment schedule should be such that the money is taken back within 85% of the economic life of the project. Within 85 days the repayment has to be finished, okay. So the original or revised repayment tenure, including the moratorium period if any, shall not exceed 85% of the economic life of a project. So like in 85 days the repayment should be finished after the project has started working, okay. So in under construction projects where the aggregate exposure of the lenders is up to rupees 1,500 crores, no individual lender shall have an exposure which is less than 10% of the aggregate exposure. So that means if there are 10 entities, if there are 10 lenders, they individually need to have at least 10% of aggregate exposure, so that all the lenders have the say, or as well as all the lenders, they have some exposure, okay, to the project. So in under construction projects where the aggregate exposure, total exposure of the lender is up to 1,500 crores. So in this case, no individual lender shall have less than 10% of the aggregate exposure in case the project is of more than 1,000, or for projects where aggregate exposure, where the aggregate exposure, total loans of lenders is more than 1,500 crores. In this case, the exposure floor for an individual lender shall be 5% or 150 crores, whichever is higher. Okay, so remember the numbers. Now after this is under construction, when the project is under construction, once the project has started operating, after that there is no such limits that the entities have to follow. So provided that the minimum exposure requirements, this is only applying till the under construction phase. Once the project has started operating, then these limits will not apply, these minimum exposure requirements will not apply. The lenders may freely acquire from or sell the exposures as they want. Now prior to actual commencement of operation, lenders may acquire from or sell the exposures. Let's say State Bank of India do not want to hold onto the project or do not want to hold on to the loan. So State Bank of India can sell the loan to, let's say, a Bank of Baroda that is interested in this project or lending to this project. Okay, so one entity can sell its exposure to another entity, but the limits have to be followed if it is under construction. So prior to actual commencement of operation, when the project is under construction, the limits have to be followed, but one entity can sell the loan to another entity. So prior to actual date of commencement, lenders may acquire from or sell exposure to another lenders under a syndication arrangement. Syndication arrangement means multiple, there is a collaborative agreement that is signed where multiple lenders are coming together to lend to a entity. This is the idea. Okay. Now moving forward, a lender shall ensure that a lender, that is a bank, NBFC, shall ensure that all the applicable approvals or clearances for implementing or constructing the projects are obtained before the financial closure, before the agreement is signed, before the documents is signed for the approval of the loan. So it has to be seen that all the clearances, all the approvals have been taken that were required before the commencement of the projects. Okay, so let's say regulatory clearances have been taken, the environmental clearance has been taken and such. Now there are certain approvals or clearances that are contingent upon achievement of certain milestone. This is an example that is given by RBI, that let's say for example, consent to operate a boiler can only be applied for after the construction of the boiler. So in this case, the approval cannot be taken preemptively, the approval cannot be taken at a first hand basis. So in this case, this would not be treated as a applicable mandatory prerequisite at the time of financial closure. So basically all the approvals, clearances has to be taken before the documents have been signed, before the loans are approved. But in certain case of the clearances, where the clearances are provided at a certain stage of the project, so in these cases, these clearances will not be mandatory in the initial phase itself. Okay, so this is the idea. Now coming to the next point, that is prudential condition related to disbursement and monitoring. So here try to understand. This is regarding the PPP model. So in the public-private partnership model, there is the concession granting authority. This concession granting authority, let's say it is the public entity, the government entity, that is National Highway Authority of India. Okay, concession granting authority means this authority will grant the projects. This concession is the projects that the National Highway Authority of India is granting. Let's say there is a expressway or the highway that has to be developed, and the National Highway Authority of India is connecting with L&T, that is the concessionaire, that is the private entity. Okay, so National Highway Authority of India is connecting with L&T for this project of this expressway. Okay, now the L&T has won the bid, and that's why the National Highway Authority of India and the L&T will work together on this expressway. So this is the idea about the PPP model, the public-private partnership model. So a lender shall ensure availability. Okay, so I hope this is clear about the PPP model, where a government entity, a public entity will work together with a private entity. Okay, and the concession granting authority is the public authority that provides the allows the bidding on the project by the private entities. Now a lender shall ensure, coming to this, a lender shall ensure availability of sufficient land or right of way before disbursement of funds. So a lender, let's say State Bank of India, shall ensure that the entity has the land or the right of way, the legal permission to use the land before disbursing the funds, because if they do not have the property, how, or they do not have the land, how they are going to build the infrastructure project, how they are going to build the real estate project. Okay, so a lender shall ensure the availability of the sufficient land by the entity so that the project can be initiated. So for the infrastructure projects under the PPP model, for the infrastructure projects under the public-private partnership model, at least 50% of the land should be available or right of way should be available. For all other projects, non-PPP infrastructure, that is for the residential real estate commercial projects, or for the commercial real estate projects, at least 75% of the land should be available. Okay, for transmission line projects, that is transmission line projects are the power transmission line projects, like the lines go na, what do we call that, the transmission lines or the power lines. Okay, so the power transmission line projects which often pass through long stretches of land, and the pillars have to be pillars should be there so that the power lines can be constructed. Okay, so for such kind of projects that happens through long stretches of land, the requirement of the land is left in the discretion of the lender based on the unique nature and challenges of each project. So for transmission line projects, as decided by lender, so how much of the sufficient land should be available with the entity, this is as decided by the lender. So this is the idea. Now coming to the next point, so I hope this is clear. Which general guidelines? All the general guidelines are there now. Okay, next is, in case of infrastructure projects under the PPP model, the disbursement of funds shall begin only after declaration of appointed date. So see, the concession granting authority has done the bidding so that the private entity can be chosen for this kind of expressway project that can work in close that can work with this National Highway Authority of India. Okay, now let's say L&T has won the bidding, but now there is an appointed date. There is an appointed date. This is the date. This is the date on which the L&T will actually get the obligation and the right to work on this expressway project. So this appointed date, this is the signing, this is the date on which the contract is signed, on which the agreement is signed, and the private entity actually get the right and the obligation to work on the project. So this is the idea that in case of infrastructure projects under the PPP model, the disbursement of the fund shall begin only after declaration of the appointed date or its equivalent for the project. So once the declaration has happened of the appointed date, only after that the disbursement of funds should happen, because there might be various entities that are bidding, but some entities, they take away their bid also, or they leave the project also before starting the project. Okay, so in this case, once the appointed date or once the contract has been signed, then only the disbursement of the fund should happen. Okay, this is the idea. Next is, however, in cases where non-fund based credit facilities may be mandated by the concession granting authority, that is the government body, as a prerequisite for declaration of appointed date. So in certain cases, what happened, that the concession granting authority is saying that, okay, this entity has won the bidding, but we will do the agreement, or we will sign the agreement only when this entity can get the guarantee from the bank that this entity will complete the project in the given timeline. Otherwise, the government will face the losses if the project stretches for a long period of time. Okay, so the L&T will have to get the bank guarantee from the bank in regards to the performance of this L&T, or let's say the National Highway Authority of India or the concession granting authority is saying that first the L&T has to get the letter of credit, from the bank, that the bank is agreeing to give the loans to the L&T so that the L&T can put some money in this project and can start the project. Okay, so concession granting authority can put certain conditions that the private entity first has to bring the performance bank guarantee, that the bank is guaranteeing the performance of the L&T, that the L&T will complete the project in the timely manner, in a good manner. Okay, and the concession granting authority is also saying that the L&T should get the letter of credit where the bank promises to provide the loan to this L&T, or where the bank promises to provide the loan or money on behalf of this L&T. Then only the National Highway Authority of India will sign this agreement. So this can also happen where in cases where these are the non-fund based credit facilities. Okay, non-fund based credit facilities, these are bank guarantees or letters of credit where the bank doesn't give money upfront, but bank is promising to pay on behalf of the borrower if needed. Okay, so the non-fund based credit facility, these are the non-fund based credit facility where the money is not given but the guarantee or the letter of credit is given. So in cases where non-fund based credit facilities may be mandated by the National Highway Authority of India or the other government entity as a prerequisite for declaration of appointed date and for signing of the contract, a lender may sanction such credit facilities, such non-fund credit facilities in adherence with the existing regulatory instructions. Okay, so in respect, now maybe the appointed date has been stressed out, okay, and like taking the letter of credit, taking the guarantee, so the L&T required a month or 2 months to take all the documents, to bring together all the documents. So if the appointed date has been stressed out and let's say it has taken 2-3 months extra, so the commencement date that was promised will also be stressed out. Let's say it was promised that the project will start from 1st January 2035, but because the appointed date, like because of the signing of the contract, it took extra time, so maybe now it is said that the project will start from 1st of June 2035, okay, rather than 1st of January. Now the project will start from 1st June 2035. So in respect of the exposures above, in respect of the discussion above, the original date of commencement of the project documented in the financial closure document may be modified to reflect any change in the appointed date, by the government body prior to disbursement. So before the disbursement of funds, there will be a supplementary agreement that will be signed between the L&T, that is the, between the lender, that is the State Bank of India and the multiple lenders, and the debtor, that is the L&T, subject to reassessment of the project viability. Now the project is viable or not because the extra time is required by the entity, and obtaining a sanction from appropriate authority. So basically in respect of the exposure above, the original commencement operation date documented will be stretched out, will be extended if the appointed date has been changed. So this will be reflected in the date of the commencement of operation also, and a new agreement, a supplementary agreement has to be signed between the lender and debtor, where the lender is doing the reassessment of project viability also. Okay, so a techno-economic viability, so the bank also has to do a technical economic viability, that this project is economically beneficial or not, the risk assessment and the mitigation of plans are available or not, technically this project is good for the bank or not. Okay, so the technical soundness of the project, the design has to be seen, the project outline has to be seen by the bank. So technical soundness of the project has to be seen, the economic viability of the project has to be seen. Okay, so the bank will do techno-economic viability study shall be required for this purpose for all the projects where the aggregate exposure of all the lenders combined is 100 crores or more. Next is, a lender shall ensure that disbursal is proportionate to the stages of completion. As I have told you that all the money will not be disbursed at a point of time, the money will be disbursed on the basis of the stage of completion. 10% of project has been finished, so 10% of funding or 15% of funding will be provided. 50% of project has been complete, so as per that the funding will be provided. Okay, so a lender shall ensure that disbursal is proportionate to the stage of completion of the project. Okay, next is, as well as it has to be seen that let's say the entity that is working on the project has promised that it will be able to raise the funds through various sources, through the equity and such. So is the entity able to do so? That also has to be seen. Also, the progress in equity infusion and other sources of finance, it has to be seen that the entity is able to get the other sources of finance or not, agreed as part of the financial closure. Now last one is that the lender's independent engineer or architect shall certify the stages of completion of the project. It's not like that the entity has said that we have completed 50% of the project, so that will be agreed by the bank. No, the bank will have the bank or the NBFC will have the independent engineer or architect to certify the stage of completion of the project. Now coming to the prudential norms or regulation. Now coming to the prudential norms or for the resolution. Okay, so resolution of stress. So we have discussed the guidelines. So we have discussed the general guidelines. Now we are moving forward with the prudential norms. So in the general guidelines, we have discussed So in the general guidelines, we have discussed about the phases of projects. So there is the design phase, there is the construction phase, and there is the operational phase. Then we discussed about the lender. So financial closure. So the lender will give the money. So the lender shall be ensured that the lender only gives the money, disburses the money once the financial closure or the capital structure has been decided and the original date of commencement operation is clearly laid out. The project should be the money should be disbursed in stages as per the completion stage. The money, the repayment schedule has to be decided on the basis of the realistically designed factor. Okay, so it's not like that the commencement has started, so from today only take crores from the entity. That will not be possible, because once the commercial operation starts, it takes time. Like in the initial 1 year, maybe the entity will not be able to earn much, so they will not be able to repay much. Okay, so the repayment schedule has to be designed realistically, and the repayment tenure should not exceed 85% of the economic life of the project. Then we discuss some of the details also, that how much investment or how much exposure the lender should have. Okay, then the clearances we have discussed about, and then we discussed about the sufficiency or the availability of the sufficient land for the different type of projects. And then we have discussed about the PPP model and how the appointed date, like how the concession granting authority provides the project to the concessionaire, that is a private entity, and the bidding happens, and after that a appointed date has to be assigned. On the appointed date, the agreement actually happens and the private entity gets the right and obligation to continue the project. Now coming to the prudential norms for resolution. Okay, so here a lender shall monitor the performance of the project, and any build-up stress and resolution plan has to be made well in advance. So basically a lender should continuously monitor the project and has to see that if there is any problem that is coming in the project, so the resolution plan has to be initiated. Now occurrence of a credit event. Now usually in the case of this other loans, the stress is seen that okay, the entity, the small enterprise, the medium enterprise, the entity is not able to pay, any entity or any person is not able to pay the loan, or the person is not able to pay the EMI. Then it is said that this loan is under stress. But in the case of the projects that we are talking about, in the case of infrastructure projects and the commercial estate projects, the credit event or the default can happen in various ways. That is, default with any lender, the interest had to be paid, but the interest was not paid during the construction of the project. So the interest has not been paid in the previous 2 months. Or let's say any lender determines a need for extension of the original or extended date of commencement of commercial operation, that it is understood that the entity will not be able to finish the project in the given timeline. So the timeline has been extended by a lender. Expiry of original or extended commencement date. So the timeline has finished and still the project is not ready for commencement. Any lender determines a need for additional debt. That means the cost overrun has happened and the project requires more money. The entity requires more money for the project. So in this case, additional funds have to be infused. The project is faced with financial difficulty as determined under the prudential framework. So see, occurrence of a credit event with any of the lenders. If the credit event has occurred with any of the lender, if any of the lender sees any of these criterias, in this case, collective resolution should be triggered. Collective resolution, that means all lenders have to come together to resolve the problem. So the reference to default in the prudential framework. So usually in the case of other loans, the default is the term that is used, that okay, the borrower has defaulted, the borrower has not paid the EMI, the borrower is not paying the principal amount or the interest. But in the case of these kind of projects, the credit event is the term that is used instead of default, because maybe the person is paying, or maybe the entity that is running the project is paying the interest payments to all the lenders. But what if the cost overrun is happening, the entity requires more money, or what if the date of commencement of commercial operation has been extended, or the entity requires it as extended. Okay, so there can be various problems that can arise. So this is the idea. So any such credit event, if any of the credit event has happened, so that shows that there is stress in the project. Okay, so if any of the credit event is happening, that shows that there is certain kind of stress that is coming in the project, and in this case it has to be reported to the central repository of information on large credit. So it has to be reported here as well as a lender shall undertake a initial review of the debtor account, that if any of the credit event has happened, so this is considered a kind of default, and in this case the initial review has to be done by the bank or by the lender within 30 days from the date of such credit event. So this is considered as the review period, that actually the stress is coming or not, or the cost overrun, because in the construction projects the cost overrun happens. The cost overrun is how much? Is it very big? Is it really problematic or not? Okay, if the delay has happened, is it really problematic or not? If it has happened because of the weather event or because of some minor problem, so that is fine, but if it is because of the stress, so that has to be recognized. So there is a review period, that is within 30 days the stress has to be recognized, and what steps has to be taken, that has to be discussed. Okay, so the conduct of the lenders during this review period, including signing. So now the different lenders has to come together and they have to sign the inter-creditor agreement, so that the different lenders can take the steps together and can resolve the problem together. Otherwise all the lenders individually will go after the borrower to resolve the problem. So it will become hectic for the borrower also and the lenders also. So all the lenders have to come together and they have to sign the inter-creditor agreement, so that they can help in the resolution of the stress and they can have the resolution plan. So this is the basic idea. So the review period is 30 days. So in this case, a project finance account classified as standard, whereas resolution plan involving extension of original or extended date, as the case may be, is implemented. Okay, so the account will be considered standard if the lenders have decided, that okay, the stress is not a big stress, the credit event is not creating much of the problem in the project, the extension of the date of commencement of commercial operation can be provided. So the extension will be provided. For the infrastructure projects, the extension can be provided up to 3 years, and for the non-infrastructure projects, the extension can be provided up to 2 years. So this is permitted deferment in the date of commercial operation. Okay, original or extended date can be further extended up to 3 years in infrastructure projects and up to 2 years in the non-infrastructure projects. In case of cost overrun up to a maximum of 10% of the original project cost is not considered problematic. So a lender may finance as a part of resolution plan. A lender can finance or it can provide extra money to the borrower in the case of resolution plan. In the case of cost overrun, if the cost overrun has happened and the project requires more money, so more money can be given and the account will still be considered as standard if the cost overrun is up to a maximum of 10% of original project cost in addition to the interest during construction also. Okay, cost overrun is financed through SBCF, specifically sanctioned by the lender. So SBCF is the standing credit facility. So this is a kind of facility, credit facility, or the amount that was pre-decided by the bank, that if the cost overrun happens, because it happens in the construction projects, so if the cost overrun happens, the bank will be ready to give this much amount. Okay, so standby credit facility is a contingent credit line sanctioned for the project at the time of the financial closure when the documents were being signed initially, to fund any cost overrun during the construction phase of the project. So if the cost overrun is up to 10%, is a maximum of 10%, then the account will be considered standard, then the loan will be considered standard, and it will be considered that there is no stress, and the money will be given through the standing credit facility. Through this, the money can be given to the borrower. This is the additional fund that is given to the borrower for the cost overrun. The financial parameters like the debt to equity ratio and the external credit rating, if any, they remain unchanged or they are enhanced in favor of the lender after such cost overruns. Okay, so now for projects where aggregate exposure of all lenders is less than 100 crores, in this case internal credit rating is used. Okay, may be considered provided the project was originally not credit rated externally. So for these kind of projects, the internal credit rating can be used if initially external credit rating was not taken. So these are the ideas, that if the problem happens, if there is any credit event that is happening, so if any credit event happens, so this is considered default, but a review time will be taken by the lenders of, let's say, within 30 days the review will be done and all lenders will come together and the review will be done and they can take a resolution plan. Resolution plan can be to provide additional time for the project. Okay, additional time can be provided for the project, or the cost overrun can be handled by the lenders. That okay, if the cost overrun is happening in the project, this is allowed cost overrun, this is not a problematic cost overrun, and so the banks will allow this kind of cost overrun if it is a maximum of 10% of the original project cost including the interest, and the bank will also provide certain extra funds from its standing bank credit facility. Okay, so this is the idea. So this is the resolution plan that the bank can undertake, that the lender can undertake, providing extra funds or providing extra time, whichever is required. Okay, next is change in scope or size. Let's say the project is running, the infrastructure project is running, and suddenly it is realized that instead of connecting 2 states, now through this project we can connect 3 states by just taking a like side turn or something. Okay, so change in scope and size. So scope and size of the project, if the project wants, or if the entity that is running that project wants, the change can happen in the scope or size of the project. Okay, the rise in project cost excluding any cost overrun in respect to the original project is 25% or more of the original outlay, as the case may be. Okay, so the rise in project, because if before you were connecting 2 states with the expressway, now you are connecting 3 states, so of course more money will be required. So the rise in project cost, for the change in scope or size, the rise in project cost excluding any cost overrun in respect to the original project is 25% or more. A lender reassess the viability of the project. It is still viable, is it still profitable? On re-rating, if already rated, on re-rating, the new external credit rating is not below the previous external credit rating by more than 1 notch. So this is the idea. So this is the basic idea, that in case the change has happened in the scope and size, the lender can continue with the project if the lender finds it viable, if the lender finds these conditions. Okay, next is further, in all the above cases where the extension of time is going to be provided, where the extension of the money or more money is going to be provided for the cost overrun. So in these cases, or where the change in size or scope is happening, so in all the above cases, the following conditions has to be met within 180 days. So within 180 days from the end of review period. So starting, so remember this, that let's say the credit event was initiated. That means there was a stress that was recognized in the project, the cost overrun is happening, or let's say the timeline has to be extended. So this was considered a credit event, or let's say the default has been done by the entity to a lender. Okay, so if there is any credit event that has been initiated, so there will be a review period of 30 days where all the lenders will do the review, and if they think that okay, the stress is not very prominent, it is not very problematic, so they might provide the extension of time in repayment, they might provide the extension of time for the project, or they might give extra funds for the cost overrun and such, or they can help in the change in the scope and size. Okay, but this kind of, so after the review period, within 180 days, the steps has to be taken. Okay, so this is the idea, that after the review period, in the review period the discussion happens. So after the review periods, from the end of the review period, within 180 days, the these conditions have to be met. Okay, so first of all the required documentation, including execution of necessary agreements between the lender and the debtor, in case the scope and size of the project is going to be increased. So that means the new collateral will be given by the entity, okay, for the project. Okay, so creation of security charge, that is new collateral. For that, the charge will be given to the bank, and the perfection of the securities, that means the complete charge will be given to the bank so that they can have the right over the collateral. Okay, the new capital structure or the changes in the financing agreement will be duly reflected in the books of the lender and the debtor. So within 180 days, before the expiry of the 180 days, these steps have to be taken, that all the required documentation has to be signed, and the banks have to show these in its books. Okay, so this is the idea, that before the expiry of 180 days from the end of review period, for successful implementation of a resolution plan, so within 180 days these documents have to be signed. So 30 days is given for the review period, and 180 days is given for the signing of the document, so that all the documents are signed and both the lenders and borrowers are fine with the decisions that are taken. Now next is, if the resolution plan involving change in date is not successfully implemented in terms of paragraph 26 and 27, So this is, so if the resolution plan involving the change in the date is not successfully implemented in terms of these guidelines, then the account shall be downgraded to the NPA immediately. That means if the resolution plan did not happen, if the documents are not signed within 180 days, then the account will become NPA. So the account will be considered standard, and it will be considered that there is no stress in such if these resolution plan is adopted. But let's say that this resolution plan is not adopted and the documents are not signed within 180 days. If the documents are not signed within 180 days for this resolution plan, then the account will be turned into NPA. And if the account is turned into NPA, the banks have to maintain higher provisions. So project finance account downgraded to non-performing asset for non-compliance can be upgraded only after the account performs satisfactorily after it has started operating. A project finance account downgraded to NPA for non-compliance with paragraph 27, that means in 180 days the documents have not been signed and the resolution plan has not started implementing. So in this case, the NPA can be upgraded on successful implementation of the resolution plan. Okay, now in the case provisioning for standard assets, for the commercial real estate, the provision in construction phase 1.25% has to be maintained, and during the operational phase 1% of the 1% provisions has to be maintained. Okay, for the residential property 1% during the construction phase, this much of the provisions, and 0.75% of the provisions during the operational phase. For all others, that means for the infrastructure projects and such, 1% of the provisions during the construction phase and 0.40% of the provisions during the operational phase. In case for accounts which have availed the deferment of the date, that means the date of the commercial operation has been delayed, as per part K that we have discussed, as per part K, if there is any delay that is happening in the date of commercial operation, so in this case the project will be classified as standard. Lender shall maintain additional specific provision of 0.375% for infrastructure project loans and 0.56 to 5% for non-infrastructure projects like the commercial real estate and the commercial real estate residential property. Okay, for each quarter of the deferment that has happened in the date. So basically if the date is being pushed forward, so for the date that is being pushed forward, for all the quarters, extra provisions the banks will have to maintain. Okay, next is coming to the last few slides. So provisioning for non-performing asset, that has to be maintained. So if the account is transferred from the standard account to non-performing asset account, so if the account is becoming non-performing asset, the additional provisions has to be maintained. Creation and maintenance of database, so database has to be maintained, and a lender shall update any change in the parameters of a project finance exposure at the earliest but not later than 15 days. So if there is any change that is coming in the parameters of the project finance, so that has to be updated within 15 days. Okay, now coming to the last slide. So these directions shall not apply to projects where financial closure has been achieved on effective date. That means this guidelines will be effective from 1st October. So till the 1st October, whichever projects have been signed, whichever projects have got the financial closure, those projects will not follow the updated guidelines. That means these guidelines will not be applicable on such projects that have already got the financial closure, basically. Okay, such projects shall continue to be guided by the earlier directions. However, any resolution of any decision that is taken for fresh credit, that means new credit is given for the cost overrun or new credit event has happened. In this case, change in material terms and conditions in the loan contract. So if there is any change that is happening in terms and condition, if the fresh credit is given, so those credit will come under the directions, under the new directions, basically. Resolution of stress in loans not qualifying the definition of project finance. So if the loan is not qualifying the definition of project finance, so it will not come under the new directions, basically. So these are the exceptions of the directions. Any confusion, anyone? So let's just summarize the prudential norms for the resolution. So basically, in the prudential norms, first we understood about the resolution of stress. So what is stress? So the credit event, this is stress. This shows the stress. Now in the case of stress, first of all, inform the central repository of information on large credit, and after that have an initial review. In the initial review, this should be completed within 30 days, and here the different lenders should come into agreement to work together for implementing the resolution plan. So once the decision has been taken about the resolution plan within 30 days, then the resolution plan can be to extend the date of commencement of commercial operation or to provide for the cost overrun. So this can be the resolution plan that can be there, or the resolution plan can be to allow the change in scope and size. The resolution plan can be this. Okay. Now within 180 days of the review period has ended. So within 180 days from the end of the review period, for the successful implementation of a resolution plan, the documents have to be signed and the change has to be shown in the documents, in the books of the bank and the borrower. Okay. Then so within 180 days, this resolution plan should be signed by both the entities, lenders and borrowers. If within 180 days the resolution plan is not signed, then the account will be downgraded to NPA. Otherwise, it will remain standard. If within 180 days document is not signed, then the account will be downgraded to NPA. Okay. So once it is downgraded to NPA, it can come back or it can be converted to standard if the actual operation starts of the project and it starts providing money to the bank, or if the resolution plan initiated. These are the provisions that the banks have to maintain or the lenders have to maintain. Then we have discussed some additional points. These are the exceptions on which the directions will not follow. Okay. I hope this is clear. It was very lengthy directions, but I hope this is very much clear. So this is the first question. I hope you will be easily able to answer this question. If there is any confusion, you can ask in the comment section below. And this is the second question. Do try to answer this question. Okay. So these are the two questions that are the homework questions that you have to comment down below. So do try to answer both these questions, and I hope you will be able to answer these questions. If there is any confusion that you have in the directions, feel free to ask in the comment section. I hope you have got the basic gist of the directions. Read it once more and you will get the clarity. Okay. So thank you everyone. Thank you for joining. Project finance, first point, what? Like the definition. The predominant source of repayment. So in the project finance, if the project finance, that means if the lenders are financing the project, the predominant source of repayment, that means the repayment has to be done by the borrowers through the cash flows that are coming from the operation of the estate. Okay. So basically the lender is giving the finance to the borrower, and if the borrower, the majority of the payment the borrower is going to do after the commercial operation of the project, then it is called project finance. So the predominant source of repayment by the borrower, that is at least 51% of the payment will be done by the borrower through the cash flows that the borrower get from the project. Got it? Okay, then thank you everyone. Thank you for joining. I think now it's clear.